Atul Suri joins us. Let's take our conversation forward with him. Atul, fantastic to have you back. Thank you for joining us. We're staring at two parallel markets. Atul, Nifty at an all-time high, blue sky, green sky. It's not a red sky there. It's not a dark clouds there. But mid and small cap stocks, well, it's a red and there are dark clouds there. Which is the better benchmark? Should one look at the mid cap space and the small cap stocks and judge what is coming next, or we should look at Nifty and understand where markets are headed?
Nikunj, I think we just need to take a step back and realize that the price action that has led up to this move. So if you take the bottom of the COVID bottom, which was March or whatever of 2020, from there, the mid cap index, the small cap index has been up 200+%, right? I think 233 if I'm not mistaken. And the Nifty is up 116 or 118%. So what has happened is that from the base, the small caps have outperformed or doubled the performance of Nifty itself. So the Nifty has doubled and the small caps have done double of that. So when you see that or take that in perspective, I think it's very logical that at some point in time, the large caps need to catch up or the small caps need to rest. So if we take that bigger picture, then I think a 3-4% kind of correction that we saw 2 days ago will not really bother you because the run-up has been so big. The outperformance in small caps has been so big compared to the large caps, and not that the large caps have done badly. So if you take a bigger picture, I think a few percent here or there, and to some extent, I've always found that this is a relay race where the baton passes from the large caps to the small and mid caps, and then it goes back. Ultimately, the index, the Nifty 50, which is your front line, is driven by large caps. And at some point in time, they also get into the act. Then after some time, the baton passes back. So net, I guess the good point is that there is very good market breadth. If you look at sector performances, global market performances, I think for me, what heartens me or what I find, why I find the market has a lot more legs going ahead is market breadth. Just extending your question and probably, working on something bigger is that if you look at equity markets, it's not just India. Globally, markets have doubled from the COVID bottom. It is the US, of course, mother market. Europe, which has been an absolute dead place for almost a decade, is also at new highs. You look at France, you look at Germany, you look at commodity-heavy markets like Australia, Canada, zipping into lifetime highs. Look at something like Saudi Arabia, induced by crude prices. That has also really gone up. So what you are really seeing is a very big global equity breadth. Again, it's not just US or NASDAQ. World markets have doubled and even the Indian markets have doubled. So if we really think that we are doing something special or somebody is doing something special, I think it's a question of liquidity, and global equity markets have doubled, and that's what we are a subset of.
You're calling it a relay race. Let me use the word musical chair. The problem with musical chair is that one day music is going to stop. And if you don't have a chair, you're out of the game. How does one figure out that this relay race is still on? So it was large cap to small cap and it is small cap to large cap. How long will this relay race last? And what is the best way to approach it now, given that small cap indices are up more than 1.5x in last 1 year and the Nifty has doubled?
So the beauty is that nobody knows the answer. So I may give you a number, I look at charts, I look at technicals, and a lot of people will give you numbers. But the beauty is nobody knows the number. So for all major tops that have happened in the past, it's only after the top happens that you say, oh, well, that's where the top is. And we experience that even at the bottom. So I can give you a number, but honestly, nobody has the answer. What I look at, and through my experience of multiple cycles, is the market breadth. So I spoke about global equity markets breadth, but you look at even the Indian markets. You look at sectors. We have a across the board sector performance. 3 sectors which have been a decadal underperformance. That means for 10 years, post 2008, they did nothing. PSU banks, commodities, and third is real estate. These were sectors which did nothing for 10 years. And we've had a lot of up moves, new highs, etc. But these sectors never did well. And you'll realize that in this bull market, they also have participated. In fact, they have been the outperformers. So a very important trait of any bull market is that there should be very good market breadth. We mentioned large caps doing well, small caps doing well, mid caps doing well. We mentioned all sectors, even the biggest decadal laggards doing well. And that is very positive. So if you ask me what I saw in 2008 or what I saw in 2000, two major crashes that happened, major bull market tops, is that towards the end, the market narrowed. In 2000, it was just IT, and the rest of the market breadth got decimated before that. So also in 2008, it was more driven by infra and a couple of Reliance stocks towards the end. The rest of the market breadth deteriorated. So what gives me confidence right now and why I think that this race, I'm not talking about 1 week or so. I'm not talking about tomorrow and today. I don't know. But if you look at it on a longer time frame, why I feel that this race has a lot more legs is because of breadth. You have global equity market breadth, you have sectorial bet, and you can also see it in the advanced decline ratio. The big giveaway for me personally is that when the market breadth will start deteriorating, but the index will be kept up thanks to a very narrow set of stocks, that very often is a big red signal for me, which I really don't see right now. Corrections will come. However, I don't think that the market top is there or here, etc.
When you see an isolated sector getting punished in a bull market where everything is gone up from real estate to metals, from IT to even infrastructure stocks, that isolated sector is pharma. For a sector which had only buyers, suddenly has no takers. How would you approach pharmaceutical? Odd one out?
Right. So pharma actually has done very well, Nikuj. Pharma index is up 136% from the bottom. So pharma has not done badly. What I see in pharma is the migration away from generic to APIs. So if you look at some pharma stocks, these are these famous names, that which are getting plastered, which were very good a decade ago or 5-6 years ago, to name it, your Sun Pharma, Lupins, Reddy's, etc. But if you look at the stocks that still are doing very well in the pharma space are in a different segment. So what I feel is that pharma as a whole is not destroyed. What has changed is the move has happened away from generic to the API plays. Without naming some of the API plays because I have a vested interest and they're part of my portfolio, is that you will see that they still continue to make new highs. So in pharma also, there is a shift that's happening. It's not across the board sector. And as I said, that the pharma index is up 136%. And if you remember that in the COVID fall also, one of the sectors that probably fell the least was pharma. You look at some of the MNC pharma stocks, which have paused for a year or so, they've all started making new highs. So I think even within pharma, there is a shift that is happening within themes that they are. So it makes sense then that is how we are positioned, that we are more positioned in the API place and in the MNC pharma spaces. And that for me are very different price behavior compared to some of the generic names that you mentioned.
Okay. Hi Atul, this is Mubina as well joining in. So we are not at the top. We may see some short-term correction, but there is largely more room for an up move. Where do you think will the returns at least maybe moderate or stagnate from here on?
I think that's a very relevant question, Mubina, because we've had, as I said, market that's doubled last year, and markets don't double, indexes don't double every year. So the thing is that okay, what's happened is happened. Now what about the year ahead? So when I go back and analyze the two major market crashes or tops, let's say the 2000 and 2008, you realize that whenever the markets crashed, the first leg of the market, the first pullback, has been very similar to what we have seen. The indexes have just doubled. So after the 2000 fall in 2003, a similar thing had happened with the markets. The first stage of the bull market is always a very oversold space, or the beaten down stocks do well. Even the sectors, as I pointed out, the three sectors that have actually done best were decadal underperformers. And we are seeing that happen again. So the first leg that happened, same thing happened in 2009, post the financial market crisis. 2009 was a runaway. So the first leg, which is a year and a half, always tends to be a very sharp up move in the index markets, what I call oversold pullbacks. And that's when the beaten down stocks actually do the best. And that is what we have experienced. The second stage, when we analyze, you realize that this tends to be a period of consolidation. So when you go back and see 2000, after 2003, there was 2004, which was not a great year, really. It got a bit choppy, but sideways. And post that, the market takes off. Same thing happened in after 2009, 2010 was nothing spectacular. So markets, I feel, would enter a year and a half. Again, I don't know the time frame, but they enter the second leg, which is a phase of consolidation. Now, in a phase of consolidation, the indexes may be up 10, 15, 20%, whatever ranges we can come up with. But interestingly, this is when the differentiation in stocks and sectors happen. People start rewarding and seeing performance. In the first leg, it's whatever's beaten down, whatever's cheap, people just go and buy it, and those things double or triple, in fact. But in the second stage, you will find that the index may not do much, but a lot of stocks may be up 50%, a lot of stocks may be down 50%. And this is where I think the performance of companies, this is where growth gets rewarded. Because after the first euphoria, things settle down and people start seeing, okay, we thought this would happen. Is it playing out? And I feel that we would head into a year or plus phase of consolidation, maybe at the index level, maybe 10, 15% here, there. But still, you will make 50% in stocks that companies that deliver, and still stocks that are where they are maybe down 50% if companies fail to deliver. So I think we are heading into the second phase. And this is, as I said, what I saw in 2004, what I saw in 2010. At least this year, 2020-21 has played out pretty much as per the textbook. I hope, or the way we are positioned, are to be in stocks which have excellent growth, which have very good fundamentals, numbers, and delivery. And we think that they will continue to reward us. Just as we spoke about the pharma space, Nikunj, that even in the pharma space, there are some stocks which are falling 20% and some stocks that are up 20%. So the differentiation is going to happen between sectors. It's not going to be a rising tide that raises all boats. I think we are entering a phase of differentiation. Index may be range bound, but stocks will do their bit based on how the companies are delivering.
Okay, so Atul, since we are in stage 2, where not anything and everything will rally, but only select stocks, that's where I think your role and your view will be even more important for our viewers as a guide to what to pick. Where have you seen, like you mentioned, the parameters, strong growth, good fundamentals, good financial performance? We've seen Q1. That's largely over. Going forward, of course, many companies have given an outlook as well of what to expect. What looks most promising to you then for this stage 2 of the rally, where we could see that stock-specific outperformance?
I think going ahead, we will continue to see performance in quality stocks that deliver good numbers. It's not going to be, as I said, just a beaten down rally or a beaten down trade, which is something that we experienced earlier. So I think this whole differentiation in the market is going to happen. It's not going to be a sector or that sector. Within sectors also, I think we are going to see differentiation. So that's what I really see the market playing out. As I said, it's not going to be across the board. It's not going to be every sector. Within sectors, it's going to be more company specific and more, as I said, delivery oriented.
Right. And Atul, I guess that's already begun to play out in banks, right? Look what kind of leadership you're seeing from an ICICI Bank and SBI, and the erstwhile old-timers like an HDFC Bank and Kotak Bank are already taking a back seat.
That's right. That's absolutely true. If you look at the bank Nifty, for the last few months, it's done nothing. But there also you start seeing the differentiation. And that's where it's playing out. So Bank Nifty has definitely been one area which is an area of concern. A sector that really led, 2017, 18, 19, 20. And post the pullback that you saw, you realize that the Bank Nifty is doing nothing. It's gone sideways, in fact, slightly corrective. And that's really what I've been speaking about, that sectors or markets are not going to be across the board rallying. They will be stock specific, and that's where the moves are.
But Atul, will that phenomena play out for momentum sectors such as metals as well?
Metals is a totally different play. It is really linked to the underlying commodity prices. And for that, one has to take a step back because I always like to see the bigger picture first, that's global. And if you look at the CRB index, you realize that here is a decadal, sort of downslide, which has reversed. So I think metals are going to be, again, a very, very interesting play. The whole commodity basket, in fact, is going to be a very good play. There are a few stocks that will get rewarded, but they tend to be volatile because that's how commodities behave and they're linked to underlying prices. However, I think that the big story is going to be the impact these high commodity prices are going to have on the on your margins and things like that in a lot of sectors. Because remember that these commodities are inputs for very many companies and sectors, and rising commodity prices are going to really have an impact. So this has a bigger story, which is the whole play on inflation. The biggest probably gorilla in the room is all about your bond yields, which is something which I think is the single most, if you ask me what's the single most important parameter or area of interest, it's really where the bond yields are. Because the whole easy money policy is only going to play out and support the markets till inflation remains under check. If inflation takes off globally, and that will be very, very demonstrated by how US bond yields perform, I feel then the challenge to equity markets will come. So net, I don't think that equity markets are going to be massively challenged. You will have corrections. There will be opportunities to be in equity, to be in good quality stocks that deliver good numbers. The risk, the biggest and only risk I think to markets is if US bond yields take off. And that will happen because inflation shoots up.
Is telecom part of your portfolio, Atul? I'm asking you this specific question because a year ago, Bharti was the top of the heap stock. Then it became the bottom of the heap stock. And now that bottom of the heap stock has promised to again become top of the heap stock.
Right. So, sorry. So what is your question? I didn't get it.
My question is telecom. I mean, this is one sector where opinion has fluctuated. Exactly a year ago, Bharti was top of the heap. Then it became bottom of the heap. Now it is at an all-time high, which means that it's rising again.
Right. So again, Nikunj, it's going to be linked to what Bharti has been doing. What are the prospects of that company? It is really not just, we know the sways that are happening in the telecom sector. The
उसको बोलो markets पे जाएगी ना यार.
Vodafone, etc. So I think that the whole issue about whether it's a Bharti or it is about what the company is doing, what it's delivering. And that's exactly the point that I'm saying, that it's not going to be a runaway market that we saw anything and everything you buy. And the downer you went in the market cap space, the more money you made. I don't think the year is going to be like that. I think the year is going to be, as I said, differentiated companies which will deliver. And whether it's telecom as a sector and Bharti as a play in that, it is really, really going to be a function of how the company delivers.
Scanning through the markets right now, and you got this new space which is getting created, Atul. Now there is no historical reference for it, but we know that this is the go-to space. Whether it is the birth of Zomato or what India Mart has done, how Affle has moved, that's one space where you don't have historical data. You got rich valuations, lot of enthusiasm, lot of participation, and no reference of charts.
So I think that this is going to be a place of great opportunity and great challenges. The challenges are that, as you rightly put it, that we don't have high levels of profitability or great buffers or much of a track record. So we don't know when markets correct or when these businesses get challenged, how they're going to pan out. So if you are in this space, you must have that stomach for that kind of volatility, because these stocks will correct 20, 30%, at a dime. If the markets go down 5%, these stocks will correct 20%. So you're going to see that kind of volatility. So you need to allocate sensibly in these stocks so that you know that you allocate enough that you enjoy the upside, but yet at the same time, whenever volatility happens, you are able to stomach it. Also, I feel that for us in Marathon, what we have consciously done is that even in this space, we have focused on profitability, because there are some companies out there which still continue to deliver, or which have underlying balance sheets and P&Ls, which may not justify these rich valuations, but gives us a sense that their existence or their survival is not going to be very challenged. So I personally am in that school of thought that yes, I like the new age businesses. I think they're going to be big wealth creators, and we can see that in the US, the kind of wealth that's been created by the big four or big five. However, it is very important that they are backed up with numbers. And that's where we deviate to those companies where there is actual delivery of numbers. They may not be cheap. However, we find that ultimately that's how markets will reward. That's how markets will help us to withstand the volatility.
Well, just to summarize our conversation then, Atul, the strategy, your view is that we're not yet at, a top. There could be some correction, but the markets will go higher. The breadth perhaps will narrow a little bit. We'll see better performance from the quality names, the strong fundamental names, etc. But since you're saying that the index may stay range bound, what could be the next trigger really? Because if markets have to go higher, they usually require some sort of trigger. And also, since you're looking at quality and since you're looking at good financial performers, those are the guys who have expensive valuations. So clearly that means you think valuations are not a concern, the fact that they are expensive?
So I think that the big challenge, as I said, is the whole global piece. We all need to accept, or we know by now that this is a liquidity infused market. There has been a lot of money pushed thanks to the Fed and the various Feds across the world. So as long as that keeps going, I think the machine will keep moving. The risk to global markets is that as and when there is tightening or tapering, how things pan out. So I feel that that is something that will be a risk. And as and when that happens, or if bond yields go up, that's where the whole question of valuations, growth versus value as an investment theme will really play out. We got a precursor to that about 3 to 4 months ago when when interest rates in the US bond yields went to 1.74. You could see that how portfolios were moving away from growth towards value. And again, when bond yields started coming down to around 1.2 or so, you'll find that the world has again moved to growth. So I think it's a much more, it's more directional, and that will happen globally. And the key point, as I continue to say, I think the most important variable, most important market indicator or what have you is ultimately US bond yields. And that is really telling us or giving us direction as to what the US investors, markets, traders think is the direction of inflation and interest rates. Because we know that the liquidity that is infusing, running this doubling of equity markets, doubling of commodities is thanks to that kind of liquidity. And if you can get your pulse on that, I think that's when you can actually pick a turning point. At the moment, there are no red signals from me. If it goes beyond 1.74, the US 10-year, which was the earlier high, and more so above 2, I think that's when I would really be worried on a larger market play. Otherwise, I feel that there will be utterances, whether the inflation is transitionary, is it structural, is it a restart trade and things like that. So there'll be a lot of commentary. But if there's one single thing that I look every morning, or the thing that sort of drives my thought process, is the way where US bond yields are heading, because that will tell me where the liquidity is flowing, and that is really where the markets are ultimately going to go.
All right. Okay, well, Atul, we leave it at that. Thank you so much for joining us this morning on the market.